Hello and welcome to Cliff Kuehl's Notes. My name is Shruti Shakar. Today over Skype we have Nomi Prins, former managing director of Goldman Sachs and the author of All the President's Bankers, here to talk to us a little bit about what's happening with our financial crisis and our financial system. So thank you very much, Nomi, for being here with us. I really do appreciate it. So I want to delve right into your book and the concluding point that you sort of state, something that we here at Cliff Kuehl's Notes also are very much in agreement with. That is that either we break the alliances of the power elite or they will break us. Now, I was wondering if maybe you could go a little bit in depth with this. Now, I know that in America, it's not the money that is not controlled by the people, and that there's a lot of implication that has come out of this, and people aren't understanding that the problem that is coming from this, the problem that they are not controlling it, that it is actually smaller elite groups that are controlling the money. How can we explain this to Americans or to people who don't really understand the implications that come out of a small elite groups controlling our money?
Yeah, well, first of all, as you mentioned from the end of my book, the idea of the political financial elite, or in the past it's been called the establishment. Actually, in some circles it's still called the establishment, but whatever you call it, the group of individuals who basically run the White House and the highest echelons of the government, as well as banks like JP Morgan Chase, Citigroup, Goldman Sachs, and the highest echelons of the financial system in the United States have a very long and fused relationship. And one of the things that I did is go back and trace that relationship to the individuals over 100 years to show and to examine how these personal connections, associations, bloodlines, family connections, mentorships, appointments in and out of public and private sectors, how all of that coalesced over decades to form American policy domestically and economically, as well as internationally over this time period. And where we are today is in many ways a culmination point of how those associations worked together over the years to establish this elite hierarchy of individuals that control the financial system. In the government, they adopt policies that enable the financial system to behave in certain ways, and in the financial system out of Wall Street, they want certain policies that enable them to be as unencumbered as possible in terms of regulations or any sort of boundaries to their practices. And these two things together have resulted in an environment that's inherently unstable for anyone who's not involved in that elite group, for anyone who's not either making those policies or benefiting directly from them. And that's one of the things that we've noticed in the wake of this particular, most latest financial crisis of 2008, which I believe is still ongoing in many ways. It has just been plastered over by some of the requirements of these same individuals or their philosophies and their legacies, whether from the White House to the Federal Reserve to these most powerful banks on Wall Street, because together they decided, when there was such an implosion in the financial markets, in the underlying economy by extension, and continues in the underlying economy for everyone, for all of us by extension, the decisions were made to basically buoy up the financial system as it exists and to put money into it, to bail it out in terms of actual finances, to give it loans, to give it zero interest rate money so that effectively banks can borrow at nothing, or they can pledge their still bad debt to the Federal Reserve in exchange for money that they can then use and reuse for other risky practices going forward. So nothing's really changed in the wake of this crisis because that power elite hasn't changed. And no leadership has come in either into Washington or onto Wall Street, or that run any of these individual powerful banks or collectively, that has any desire to change how all of this infrastructure works. The result is that we as individuals have no power over this. We weren't involved in the clubs, we weren't involved in the golf games, we weren't involved in the yachting experiences, we weren't involved in sort of the backdoor conversations that really affect policy more than what we see publicly, more than what we see in the media could ever actually affect policy. And as a result, we're the recipients of tremendous risk on our own economies, on our own personal economies, as well as volatility in the markets in which these participating institutions are involved. And that's something that can hurt us in different amounts, in large amounts, in acute amounts in a crisis, or just generally kind of slow burn amounts over time.
So you had mentioned that the elite that was chosen, several hundred years ago, is very similar to how it's still being chosen today. And I had, watched an interview earlier where you had mentioned that a lot of the people that were chosen, to be part of this elite that was kind of managing our money was kind of known by the presidents. Basically, they were, in their book club or quote unquote cigar clubs, if you will. Now, how has that has that changed over the years, or is it similar now still? And is that why we are still in this financial crisis, because this elite group is being chosen in that same format from the past, or is it different in some sense?
Yeah, I mean, to a large extent, it remains self-selecting. But what's different, and that's a really good question, is that back, say, 100 years ago, when J.P. Morgan, whose name, J.P. Morgan Chase, is on the front and runs the largest bank in the United States, J.P. Morgan himself was a close associate with Teddy Roosevelt back at the turn of the century in the United States. And when there was a major financial panic that started to a large extent because of fraud, because of collusion, not necessarily of J.P. Morgan, but of other individuals in the financial markets in New York at the time, that was going to hurt individuals, depositors who had their money with what was called trusts with the banks at the time and had no insurance for that money. So when the banks went under, all their money would be gone. Teddy Roosevelt said to J.P. Morgan, who he knew, who he trusted as an individual, as a person, here's some money from the Treasury Department. Do with it what you will to just make the situation go away. So this was a situation where, so this wasn't voted upon by Congress. This was something that happened between two individuals who knew and trusted each other, who traveled in the same circles, and who wanted to, for different reasons, keep the financial system intact. Now, J.P. Morgan did use that money from the Treasury Department. Teddy Roosevelt later in his memoirs did say that J.P. Morgan saved the country from a catastrophe. And things kind of went from there. So a few years later, so this is 1907, a few years later, by 1913, there had been a meeting in between where J.P. Morgan had organized individuals who were related to him and given them a pass to a place called Jekyll Island, and there's been a number of books on this, but it was basically an exclusive club where a lot of the individuals who were running major corporations in the United States at the time had memberships, and you couldn't get onto this club. It was basically kind of had waterways all around it. You couldn't get onto the club or onto the grounds even without being a guest of a member or being a member. And so in 1910, there was a meeting at Jekyll Island. J.P. Morgan was not there, but people who were associated with him were there. And so there was four bankers, not from the Morgan Bank, but from what became National City Bank, Bankers Trust, people that were associated with him because these banks did work together and had associations from prior to this moment. And a senator from Rhode Island, whose name was Nelson Aldrich, who was also the head of what's now the Senate Finance Committee, so one of the most powerful men in Washington in terms of the financial system. And they all got together and got into this island to even have this conversation at this club because of the membership that was afforded to them, the guest membership of J.P. Morgan. So there was definitely a very close association there, and the idea was that they would create this bank for the United States, basically for the banking system, because that's who was there. And they would, this Federal Reserve, as it ultimately came to be called, would back for future crises. So Teddy Roosevelt wouldn't have to sit in the White House and wonder what J.P. Morgan was going to do with the Treasury's money to make it all go away. There'd be some other body, some other institution that could be able to do that for J.P. Morgan, for the banks, for the system. And that's really how it came about. And in 1913, it was signed into law, not by Woodrow Wilson, who had prior to that come into Washington by himself, on his own merits, but also because he was a friend of the Morgans. J.P. Morgan's dad actually had been one of the benefactors of Princeton University,
Wow.
where Woodrow Wilson was president before he became president of the United States. So again, these associations go back very far. We see them today on the monikers of these large institutions. What's happened in between is many other people had similar associations with presidents. They were in and out of Washington. Their institutions got bigger. Policies helped their institutions got bigger. Sometimes Wall Street bankers were aligned with the government, with the presidents, in terms of what they decided the country should do or be. Sometimes they were in opposition. Today, to get roundabout back to the end of your question, today what's happened is all of that legacy has fortified these relationships and the ideology, the choices that say when there's a financial crisis, these largest banks need to be bailed out by the government, or they need to have the Federal Reserve support them, because that's how it was kind of set up on a personal level and then a policy level and on a joint belief level to begin with. The difference now is that there's a lot more people in the mix. There's zillions, zillions. It seems like zillions of lobbyists. There's many lobbyists. There's many lawyers. There's a lot more people involved in shaping how policy looks on paper. So the ideology is there, is still there. That's kind of more general. But then there's all the specifics of all these extra individuals in the way, which makes the process a little bit less personal, but still as functional in terms of this collaboration that has been in existence for so long continuing.
Now, do you think that because of the current financial crisis that's still looming from what happened in 2008 is still occurring, do you think that there's some sort of sight in the future of having a global financial war, or do you see it happening right now? And if so, do you think that who do you think are the main key players that are kind of involved in this financial war, if you want to call it?
Well, what's happened is, and again, it's a financial political war, because what's happening is you have the government banking associations, and then you have the sort of central bank entities, the World Bank, the IMF, and you have the central banks themselves, and they're all sort of on the same page, and yet have slightly different roles in enforcing the financial system's status quo. And so it so happens that in the wake of the financial crisis, we all saw, or anyone who was looking saw, that the rot sort of in the middle of the financial system was associated with a lot of risk that these institutions were creating, that they then said, no, we didn't know, it wasn't our risk, stuff happens all the time, it's just an economic cycle, whatever. But the reality was they were creating, because they could, certain kinds of assets because they could, backing them with certain types of credit derivatives and other more complex sort of engineering mechanisms because they could, distributing them throughout the world because they could, and having small towns, as far as, from the U.S. to Norway, borrowing extra money from their own municipalities and local banks to buy this stuff. And so when it all implodes, that entire system that enabled all of that to occur, should have been much more in question. And instead what happened was it was given support. Central banks around the world have reduced their rates. The Federal Reserve to zero, the ECB, the European Central Bank, to zero. Even Japan's been at zero, but just that they've all found ways to reduce the cost of money to the financial institutions, because they get the benefit of the zero interest rates in a way that individuals don't. We still get double-digit interest charges on our credit cards. We still have to pay high interest rates on student loans. It doesn't really filter down, or small business loans. It doesn't really filter down to regular people. But the banks, because of their associations and how the system works, can get money very cheaply. They can also get rid of any excess assets they had from this period, any overhang, back to the Fed in the case of the United States, back to the European Central Bank in the case of Europe. So Deutsche Bank is now basically selling some of their crappy bonds back to the ECB, who's just giving them money for them. JP Morgan and Citigroup and so forth did that with the Fed. So it's all just kind of been plastered over. And so these banks look like they're all healthy because they've received all this very cheap money.
Right.
And they've been able to dump remainder assets that they couldn't dump anywhere else onto the central banks. And all the governments that were associated with this and are associated with this seem to think this is a good idea. There's no president, there's no prime minister, no one's saying, why is this good? What they're saying is, by having this policy that these central banks and these banks and everybody's committed to over these years, somehow it's helping the overall economy in the United States, and it ultimately will help the overall economy in Europe and so forth, when there's no actual correlation to the regular economy. This has been a policy that has helped the banking system reestablish itself as supposedly solvent, but not really fix capital growth, development, infrastructure, small businesses, reducing the debt of individuals, good jobs, any of that on the bottom level to any extent that's meaningful.
So correct me if I'm wrong with what I understood, what you said is that governments kind of just do what they do because they were able to do it at the time. They thought that this would be a possibility, and then they kind of dumped whatever issues they had when the financial crisis happened onto the central banks and private banks, and anyone else that would try to be able to help. So how was it possible that the central bank was able to actually sustain all of this pressure? I mean, what were they doing to actually maintain the financial system? Because to me, when I'm hearing this, it sounds like there's just so much pressure. They're almost in the deep end. So what are they doing? I mean, I guess are they collaborating with private banks? What are they doing to maintain our financial system?
Well, first of all, the assets are coming from the financial system, so it's kind of in this circular movement of the actual government, so the White House, taking a slight back seat at the beginning of this crisis to the Treasury Department, which is part of the White House, but to allow the Treasury Department and the Federal Reserve, and the leaders of the private banks of Wall Street at the time to decide what needed to be done in the wake of the crisis. So you had these people in a room, the senior elite from the government, the Federal Reserve, the New York Federal Reserve, and the private banks sitting together trying to figure out what to do in a financial crisis that they caused, which now the story has been that they haven't caused. It just sort of happened, even though collectively Wall Street has paid billions of dollars in fines, which to Wall Street is quite a small figure. But they have not confessed, but at least been sort of fined figures for their behavior, their practices in the onset and into the financial crisis. They just haven't changed any of their practices on the way out. And so what the government has done, sort of from the White House office, from Prime Minister's perspective, in Europe, or president perspective, or whatever, they've basically stepped back and allowed the central banks and the private banks to effectively work together, because the policy that the private banks want and the policy that the central banks provide is on the same page. It's on the page of providing liquidity, cheap money to the financial system, buying assets, which also have the side benefit of making assets that they continue to hold, that Wall Street continues to hold, look like they're worth more, because if you have someone buying them, then what you continue to keep on your books looks better because someone's going to buy it, even though it's just a central bank. So everything looks better than it is. Why do they do that? Yeah, the pressure is there to not have the financial system implode. The narrative and the myth of the narrative is that this policy that I just described is somehow net beneficial to people, and we should embrace it, because without the financial system being subsidized in this manner, more hell would have broken loose. And so that's the story that everyone who was involved in the activities, or at least some of the ones that have been involved that have now gone off and written books, like Ben Bernanke, who was head of the Federal Reserve at the time, Timothy Geithner, who was head of the New York Fed during the crisis, and then Treasury Secretary for Obama after the crisis. These people have now written books and have gone on tours and on media tours saying, we did what we had to do. Otherwise, everything was going to fall apart. But in reality, the recipients, the bodies that were most saved were the ones that were most involved in their own saving, which is the private banking system, because the central banks and government policy made it available to them.
With that being said, then, would that be an underlying reason as to why central banks and governments would be supporting banks instead of more directly supporting like a real economy?
Absolutely. Because, first of all, the amount of capital that is controlled by banks is vast. Some of it's in actual deposits and actual real assets, and some of it's in derivatives and other types of assets that have embedded in them various types of risks, which, if they go badly, also have a call on capital, have a call on deposits, and so forth in some manner. Now, some insurance is there for some deposits and so forth, but the reality is if banks start to crumble again, it hurts everybody's personal economies by more, and so there's going to be a negative impact. But one of the reasons that it's been spun, this whole policy has been spun as helping, is to avoid the hard question that you just posed, which is, wouldn't it have been better to find a policy that actually helped foundationally, help people from the ground up? And yes, I actually wrote about a policy that could have done that instead of bailing out the banks and buying their bad assets and giving them cheap money to keep them solvent when they weren't, and allowing them to continue on in the same practices and to emerge from the crisis bigger than they were going into it. Rather than having that happen, other things could have been done. For example, subprime loans were at the heart of the crisis. So rather than buying assets and giving money to banks for them that had subprime loans in them, all mixed up together, there could have been better legislation or better policy or a string attached to that money that required banks to renegotiate a substantial portion of the mortgages that they were getting relief on from the Fed for the assets that contain them, and that individuals largely did not get a benefit for. Because if that had been done in the beginning, if the mortgages that were at the heart of all these esoteric assets that should not have been created as risk-laden as they were to begin with and sold everywhere to begin with, if that had not happened, if those subprime loans, when they started to go sour, were renegotiated, that would have contained the crisis from the get-go, and at the same time, banks could have been slapped with much more stringent rules as to what they could or could not do when they knew that loans were going sour, or in the very production or issuance of those loans to begin with to people.
So why was it that they didn't notice it from the get-go then? I mean, if they saw that this was happening, why didn't they just, kind of cut it off before anything bad could happen?
That's a good question, because both the Federal Reserve and the New York Federal Reserve and the Treasury Secretary of the United States, Hank Paulson, at the time when these subprime loans were starting to go sour, when institutions like Bear Stearns and Citigroup, who had different kinds of mini institutions off of their balance sheet that were sort of less public, but that officials in Washington would have known about because there were meetings about them. When these things started to go sour, it was still too late, but it wasn't as late as it got into the fall of 2008. It's just that these people decided um, to ignore it. And the New York Fed in particular said the housing market was fine. The Treasury Department said this was, things were a little weak, but this was just a blip. There was such a cover up job. Now they're saying there's no way they could have known. There was no way they could have known, even though these banks that were involved in these loans had records as to when they stopped paying. It's very black and white. A loan is paying, a loan's not paying. It's really simple. A loan's paying all the time. A loan stops paying this month and next month and next month, and a few months later it's in default. It's not really hard math. It's a black or white kind of situation. But they decided that in aggregate to ignore how these loans were being used to create much more profitable assets and transactions between the big banks and with their other clients, with the people that they sold some of this stuff to. They just chose to ignore all of that and decide that everything was going to ultimately be fine. And so now they can say, well, we didn't know. No one could have known. I mean, people knew. People were writing. I was writing about it. You can go back to my stuff from 2006, 2007. I'm just one person. I wasn't the only one doing it.
Right.
So there's definitely material out there. It was just
It just honestly, it just seems like it's such a joke to me, to quite honestly. I mean, I'm listening to you, and in my head I'm thinking, how did they get away with this? I'm so shocked just listening. This just our conversation right now. I just don't understand, how were they able to get away with something so big like this and just kind of brush it under the rug, almost like that there's that lie when, they clearly could have fixed it. I'm just so in shock.
it is shocking. I'm glad, we all should be in shock, because the whitewash over this situation was so big, and because of that it has so not been repaired, that we continue to be at risk from all of it. And the reality was that if there's a financial system, and that again includes the government, the central banks, the private banks are the most elite of all those, if they are collectively trying to reinforce each other's status quo, then when anything pops in that might alter that or might shine a really strong light on what's actually going on, they sort of all retreat and lock arms and, sort of buy the same, or they sell the same story. Or they create the same story and then they sell the same story, and that's kind of what happened. And all the other thing is the money is not really anybody's. When the Federal Reserve creates, as it did, $4.5 trillion worth of sort of cash to buy Treasury debt. So first, actually, the Treasury has to issue debt so that they can give it, so that the banks can sort of take it on their books, so that they can sell it back to the Fed and get money for it.
Right.
It's ridiculous. As well as also, remove some of the assets I mentioned before that were mortgage related and give them to the Fed. And the Fed all of a sudden bought, with money that didn't exist before, $4.5 trillion worth of assets just from U.S. banks. And then you multiply that by what the ECB is doing in Europe and so forth. None of that should be happening. It's a ridiculous way to run a financial system or an economy. But the fact is, it was doable because the structure that we have allowed it.
So now, that being
question the thing they're running, the thing they're sort of have jurisdiction over.
So that being said, then, because you were mentioning how it's so easy to just get the loans, or just so easy to print the money, or so easy to kind of borrow those assets. So can you explain to me how it's that easy, for the central bank to produce that much money, or versus for the central bank to liquidate assets that easy? I mean, how is it that it's that easy for a system to be able to do something like that?
Yeah, it's mind-boggling, and I should mention first of all that as yes, it's easy, and I'll get to that, and it's been more easy in the last 6-7 years than ever before, because we've never. Certainly in the United States, history of the Federal Reserve since 1913 had anything like this epic a scale of sort of printing money, buying assets, and sort of posturing over really dangerous spots in the financial system. It's never been this bad and this big. So that's one really troubling thing. But it's also an issue of it's easy because of how these bodies were structured. For a bank, particularly because there's been so much deregulation over the years, and what that means is that banks get to buy other banks, and banks get to buy people's insurance contracts, and banks get to create securities that have people's mortgages in them because they also have arms or sort of components of them that are allowed to do that. So to one extent, it's because of laws and policies and regulations that enable banks to sort of get their hands on a large amount of loans, or to issue a large amount of loans, and under the same roof recreate those loans with all sorts of other types of assets, derivatives, other financial instruments, and sell them off. That's agreed upon policy by the individuals that ran these banks, particularly the ones that had the strongest relationships over the years. I mentioned J.P. Morgan.
Right.
I had in there in the 70s.
And it goes back to that whole thing that you were saying earlier.
That, but even those people they weren't quite as insane about the risks they were taking even back then. Even in the crash in 1929, which created had a tremendous Great Depression in the United States and throughout the world, it wasn't as bad and as big as kind of what's going on right now in terms of what they can get away with. So some of the things they got away with then, they're still getting away with now. It's just on a grander scale. And some of the individuals throughout the years, the middle of the 20th century, David Rockefeller, who ran Chase, Walter Wriston, who ran National City Bank, which is now Citigroup, these individuals all took little chips away at any rules that kept practices from getting too risky in any one institution. And so when you keep on taking away a rule and the president says it's okay, you take away a rule, Treasury Secretary, it's okay. Take away a rule, the Federal Reserve Chairman applauds you. When all that keeps happening, you do get to a place where you become this idea of too big to fail. You have too much access to too many deposits, too many insurance policies, too many loans, that if you fail, you sort of spill mud on all of them. And that was the argument for saving the banks that contained all of them, rather than breaking up the banks, or rather than going directly to the mortgages and fixing them on behalf of individuals.
Lastly, so I want to just kind of wrap up lastly and ask you a little bit about going back to the financial crisis once again, and what you had said so far. I almost want to say that there is some sort of a quote unquote global financial war that's happening between what's happening in the West financially as well as what's happening in the East financially. What would you say towards that? Do you think that that is something that could is a possibility or is happening right now? And that being said, do you think banks in Asia, for example, could, for example, the Asian Infrastructure Investment Bank, do you see it having any conflict with the IMF or the World Bank towards the United States or the West in the sense of our current financial crisis that's happening?
Yeah, well, one of the outcomes on this global financial competition or financial war scale is that China, for example, noticed that the way we run our financial system is very dangerous, because you'd really have to be an idiot or a dumb country not to really see this. As we've just been taught, once you get it, you understand the risks that are involved, and especially if it's happening to your country, your economy, your people, or even your own elite.
Right.
So what has happened in the wake of the financial crisis is that the countries that were less involved, because their banks weren't at the center of the financial crisis, to the extent that the U.S. banks were primarily and the European banks were secondarily, basically said, wait a minute, we don't need to be involved in this. We need to have some independence, yes, on a political basis too, but also from a financial risk basis, from this kind of thing going on and potentially taking down our economy. So the byproduct, on an extent, is that China is saying, we need to have some independence or more independence from this. China is really related to the United States in that they own a lot of our bonds.
Right.
We owe them a lot of money. And because they own our bonds, they don't necessarily want the United States to tank, because that means the bonds they're holding lose value, and they own them, so they don't really want them to lose value. So there's all these other kind of relationships that come into play that create an alliance and not a war. But on the other side of that, they want to be able to have jurisdiction over developing their own country, over directing international funds to them, instead of just to the projects or countries or policies that the United States has had the most jurisdiction over. And so the AIIB is just a way for them to have just one, because I mean, there's a lot of these entities, the World Bank, the IMF, you have entities that have been designed since World War II to supposedly provide aid for the infrastructure of developing countries and for development, in conjunction, as it turns out, for the World Bank, with Wall Street helping to sell their bonds and raise money as well. So that's another episode of that story. But there are countries that want independence from that, and that's what's going on right now. It does manifest also as a currency war, and that
Exactly. I was going to ask, I mean, how does that, I guess, procure to a currency crisis or a currency war, if you will? I mean, because right now we are basing a lot of our system on the US dollar. So how does that affect, what China's trying to do, which is gain their, or even just any of the BRIC countries, for example? Like, how are they trying to gain that independence, and how will that affect our financial economy in the future, I guess, if that's something that I'm kind of concerned about?
yeah, they're trying to, and again, for those reasons, there's the political reasons of just wanting to be more powerful, and there's the financial reasons of wanting to be more powerful, and then there's the economic reasons of wanting to not have your risk defined by someone else's policy. So you mix all these things together, and add into that the currency aspect, which is that when you're denominating your exports and imports on your currency, you do want to have some more control over it than just having it be dictated by how strong the US dollar is. Now, I've said many times, as have other people, that there's no reason why the US dollar, from all these policies and all the structural problems that we have, that we've just discussed, should be as strong as it is. The reason, though, it is as strong as it is not because of policy, it's because of dominance. It's because it's just the biggest currency, not because it's the smartest run currency. And so the idea of having war, having sort of bites at that currency and trying to dilute it by having other trade partnerships and other currencies engaged with each other, and away from being denominated in the dollar, is a way to strengthen the playing field, the currency playing field, the currency battlefield, however you look at it, to an extent. Now, I think that's going to take a very long time for the same reasons. I think the U.S. dollar shouldn't be as strong as it is, but it is.
Right.
Because we are big. We've had these policies
And just correct me if I'm wrong, is the only reason why it's currently the strongest one mainly because of what happened, I guess, during the Cold War, and then just that the U.S. having that stronger after World War II, it just became a lot more stronger, and then from then it was just, that's why the U.S. dollar is just holding so much strength. How is it possible that they were able to hold it for so long? And, in continuing with your discussion, how can another power try to overtake that without an actual global war occurring?
Yeah, well, that's the thing. I mean, as you mentioned, from World War II, and even after World War I, the U.S. dollar became more dominant. The United States became more dominant. They had the Fed that was in existence just into World War I, which was convenient. And it also had these private banks that were effectively acting as the World Bank at the time, which is that in the wake of World War I, they were providing loans to Europe, loans to the allies of the United States, and as a result, they got stronger. They got more tentacles into those countries, and the United States government also got stronger because they were like the victors and had the least losses after World War I. The same thing happened after World War II, to a larger extent, because after World War II, also the World Bank and the IMF were created, and these are institutions that are largely governed by the United States as the strongest member. So they consolidated that idea of development money, that idea of aid, that idea of private money and public money kind of working together with their ally countries. And so they manifested the dollar, as well as trade, as well as private businesses, private investments, all connected to each other with their allied country friends. And so they kind of created a wrinkle in the world where the U.S. dollar was like their friend. And then it got propagated more and so forth. So that strengthened it. And then, over the years, that continued to happen. The dollar was what denominated oil coming out of the Middle East, as bankers were going there to create deals with the Middle East counterparties and the oil companies and the banks there that couldn't basically loan money from the Middle East, but it had to go through U.S. banks or through U.S. banks in London into Latin America and other countries. So again, they were controlling the process. So that's why it's going to take a very long time to break into that. They controlled the process in the wake of the financial crisis because because the Fed and the ECB collectively, but run by the Fed policy to begin with, dumped so much money into the financial system and bought all these assets and substantiated all these policies, and kept the strength of the dollar relative to the euro because the dollar started it, the Fed started it, the White House started it, and they were biggest to begin with, and they propagated their policy and remained big and remained powerful. Coming against that, any currency coming against that, even with a strong economy like China has, is a very large and long battle, if it's even a battle that could be fought. You have so much entrenched global dominance of a country and of its currency that you can't just chip away at that. It didn't just happen last Tuesday. This has been happening for for over a century.
Right.
And so in order to change that requires time. So what's happening now is that we're just in a very interesting period of history because it's hard to say where this will go. Certainly there will be more partnerships on the outside, but certainly the U.S. and its financial system as European partners will continue to fight against those to maintain the global status quo, and that's just going to create a lot of back and forth. And at the end of the day, all these countries are connected with each other anyway, because they want to maintain some sort of an economic stability, at least for the upper echelons of their people, and so there's that going on as well.
Right, right. Well, thank you so much, Nomi, for joining us and, trying to explain to us what's happening right now currently in our financial crisis and system that's happening. I really appreciate it. Thank you so much for joining us.
Thank you very much for having me.
All right, take care. Bye.